Once again, market veterans, financial analysts, and economists are sending a warning message for investors. Brace for the biggest stock market crash of all times. A major pullback has already started. One of the most recent alerts comes from Moody's Analytics chief economist Mark Zandi, who expects a market correction of up to 20% as the Federal Reserve is left with no other choice rather than hiking interest rates amid soaring inflation. This time around, unlike other sharp drops witnessed in the past, Zandi argues that a rapid recovery won't be in the cards, particularly because the market is extremely overvalued. It would take over a year to return to break-even, he said. In an interview with CNBC, Zandi said the headwinds are building for the equity market, and the Federal Reserve has got to switch gears here because the economy is at risk of overheating. He suggested that a significant market crash may already be underway because investors are starting to get spooked. This week, the Dow just recorded its biggest weekly loss since October 2020, dropping 3.45%. Meanwhile, the S&P 500 has gone through its worst week since late February, and the tech-heavy Nasdaq also saw some losses this week, even though it's just 1.28% off its all-time high. Zandi has been warning about an inflationary spike for months, and during the interview, he said inflation was dead ahead and investors weren't fully aware of the risks. In his view, inflation is and will still be a serious problem affecting stock market and bond investors, and he sees very little chance the benchmark 10-year Treasury note yield will keep falling. I wouldn't count on rates staying at 1.5% for very long, given what's going on, he added. But stocks and bonds are not the only risky assets investors should be paying attention to, according to Zandi. There's a lot of trouble brewing in the commodities and cryptocurrency sell-offs. On top of that, he's worried about the sustainability of the housing market bubble as mortgage rates tick up. Sell-off concerns are also making Morgan Stanley analysts warn that major U.S. stock indexes are in a rolling correction, despite recording a series of new highs. As investors rotate away from higher-risk names and as market breadth declines, major indexes will remain vulnerable, analysts led by equity strategist Michael Wilson said in the note. Under the surface, financial markets have taken on a much more defensive posture, the note said. This means they are observing the initial stages of the stock market crash, as investors have started to abandon risky assets. Up until this point, Morgan Stanley has shared a less rosy and more realistic view of the markets compared to other banks. The analysts said they fully expect a market transition to happen, and in the process, several overvalued stocks will face a crash until the end of this year. At this point, all signs are there for those who want to see. Commodity prices are surging to unprecedented levels, but on the other hand, bond yields and equity markets are collapsing. The message coming from commodities and yields is clear. While inflation is rapidly going up, economic activity has started to slow down due to the relentless rise in prices, and stock market investors seem to be ignoring all the obvious signs. All asset bubbles are simply becoming unsustainable. It takes just one extra snowflake to start an avalanche. And boom, said the veteran investor, economist, and financial analyst Harry Dent in a recent interview with Think Advisor. Harry Dent said that the epic market bubble is likely to blow at the end of this month, if not September. He argued that stocks have no more place in investors' portfolios and predicted that most equities will tumble 80% by the fall. It'll be the biggest crash of our lifetime, he stressed. The worst year for the stock market in our lifetime is likely to be around the end of 2022, and for the economy, 2023, according to his forecast. The investor correctly predicted Japan's 1989 bubble burst and recession. He predicted the dot-com crash and correctly predicted the result of the 2016 elections. Now, he is saying that although investors remain bullish longer term, the economy keeps telling us things aren't as good as they used to be, and the current economy rebound won't last. It'll take one more crash to convince investors that the economy isn't as strong as they think it is, he alerted. When asked what were his main worries regarding the market and the economy, Dent just said, "I'm not afraid or worried about what's going to happen. It's just the wait. I'm waiting for the economy to get back to normal and quit having central banks manipulate and stimulate it. They're going to keep stimulating and doing whatever it takes to try to keep this bubble. But you can't just keep pumping money and pushing up financial asset prices. We now have a bigger bubble than ever. The economy isn't the same, but people are still assuming it is. No amount of stimulus is going to cure this, and investors will lose." The Economist highlighted that this is the longest bull market and the most bubbly. So when a crash finally happens, it's gonna be epic. It will be the biggest crash of our lifetime, Dent cautioned. The central banks will lose control. In March, he affirmed that the biggest crash ever would likely occur by the end of this June, and many analysts started disregarding his opinion because that didn't happen. However, Dent has a good point to explain why the crash has not occurred just yet. He said, "It's the same old story. We've been rebounding since the health crisis crashed us in March of last year. The stimulus was off the reservation. The central bank said, we'll triple down. But that stresses the system, not letting the economy rebalance, not washing out zombie companies. 20% of large public companies can't meet their debt service. So it was a massive stimulus, and now we have this bounce. But I don't think the rebound is going to last, and the markets don't think it's going to last either. The bond markets are saying, now we've got 3% or 4% inflation, while governments will keep this bubble going no matter what. So the question is, when does it blow?" And to that question, he presented the forecast that the end of this month is one of the most likely times, if not September. Dent is amongst the experts who can see that what we are facing is an everything bubble, and that includes stocks, housing, and bonds. One single failure can lead to the simultaneous burst of the three markets, and the analyst is ringing the alarm on the housing market bubble. He says it's pretty hard to hold this thing up. The biggest reason is home sales, which is the single most important thing that we buy. Housing is the biggest part of the economy. If sales keep slowing, then prices get weak. That's the type of thing that tips this thing over. What I'm seeing right now is that prices on home sales have gone down. Real estate is still bubbling up, but U.S. home sales have gone down 22 or 23% in just a matter of the last 5 or 6 months. That's a sign there's a limit to the bubble. So that's the beginning. But the downturn is going to be hard and fast because the economy is way overstretched, including low interest rates. People just assume this is going to last forever, but when it hits, it's going to hit hard. How much snow does it take for an avalanche? One snowflake. Because it's been building up and building up and building up. One extra flake and boom, he warned, revealing that today the biggest threat to the everything bubble is overvaluation. Everything is overvalued, he says. Everything is overstretched. It just takes a big enough pin to make it all go down. Similarly, the economist who accurately predicted the 2008 financial meltdown is now waving a red flag about another looming disaster. However, this time things are much worse than they seem. Nouriel Roubini, an economist at NYU Stern School of Business, argues that the next stock market crash will be the catalyst for a crisis of extraordinary proportions that could lead us to a devastating societal collapse. In an op-ed to The Guardian, Roubini argued that the same loose policies that are feeding asset bubbles will continue to drive consumer price inflation, and that conditions are right for a double whammy of the stagnation of the 1970s and the stock market crash of 2008. The warning signs are there for the global economy, and central banks will be left in an impossible position. Today's extremely loose monetary and fiscal policies, when combined with a number of negative supply shocks, could result in 1970s-style stagflation, high inflation alongside a recession, he wrote, outlining that debt ratios were much lower in the 1970s than they are now. Therefore, the upcoming crisis will be far more severe. Debt ratios are much higher than in the 1970s, and a mix of loose economic policies and negative supply shocks threatens to fuel inflation rather than deflation, setting the stage for the mother of stagflationary debt crises over the next few years, Roubini noted. For now, loose monetary and fiscal policies will continue to fuel asset and credit bubbles, propelling a slow-motion train wreck, he added. The warning signs are already apparent in today's high price-to-earnings ratios, low equity risk premium, inflated housing and tech assets, and the irrational exuberance surrounding special-purpose acquisition companies, the crypto sector, high-yield corporate debt, collateralized loan obligations, private equity, meme stocks, and a runaway retail day trading. At some point, this boom will culminate in a Minsky moment, a sudden loss of confidence, and tighter monetary policies will trigger a burst and crash, he warned. At the same time, the same loose policies that are feeding asset bubbles will continue to drive consumer price inflation, creating the conditions for stagflation whenever the next negative supply shocks arrive, Roubini wrote, underlining that the growing tensions between the United States and China threatens to fragment the global economy at a time when climate change and the health crisis are pushing national governments towards deeper self-reliance. Add to this the impact on production of increasingly frequent cyber attacks on critical infrastructures, and the social and political backlash against inequality, and the recipe for macroeconomic disruption is complete, he continued. Making matters worse, central banks have effectively lost their independence because they have been given little choice but to monetize massive fiscal deficits to forestall a debt crisis, Roubini explained. With both public and private debts having soared, they are in a debt trap. As inflation rises over the next few years, central banks will face a dilemma. If they start phasing out unconventional policies and raising policy rates to fight inflation, they will risk triggering a massive debt crisis and severe recession. But if they maintain a loose monetary policy, they will risk double-digit inflation and deep stagflation when the next negative supply shocks emerge. As if all that wasn't disturbing enough, Roubini added that due to an impending debt crisis, the government will be insolvent and thus unable to bail out banks, to bail out corporations, and to bail out households. In other words, no one will come to our rescue. We will be left with a collapsing economy, crashed markets, bankrupt businesses, and feeling the catastrophic impacts of a decaying purchasing power. This means that the coming everything bubble burst might be the beginning of the very end. As Rubini and the other experts have been trying to warn us, this slow-motion train wreck looks unavoidable. We will soon see the stagflation of the 1970s meet the debt crisis of the post-2008 period and merge into the most devastating economic and financial disaster in history. The question is not if, but when.